What's up, everybody? So, a viewer asked me a question here. What is a market maker? I've used the term in the past. I've used that term when talking about the banks and the Wall Street firms like Goldman and Morgan Stanley, saying they're not really traders, they're market makers. And I guess you could call that a form of trading. So, anyway, a market maker is basically an intermediary. And in the realm of finance, if we're talking about finance, if we're talking about Wall Street, usually talking about a broker or a bank like a Goldman Sachs, a Morgan Stanley, a JP Morgan, that sort of thing. So what market makers do is that they create a market for customers. If customers want to buy or sell, they will give them a price on both sides. So for example, let's say we're trading, I don't know, oil, for example. And I'm just going to use round numbers, right? And one of Goldman Sachs customers wants to buy some crude oil. Let's say the price is $50. And again, I'm just going to round this off in whole numbers just to make it easy to understand. So the price trading in the market is $50. Doesn't mean you can get that $50. Customer goes to a broker like Goldman, says, I want to buy some crude oil. So Goldman might offer him really a two-sided market. He'll offer him, okay, 49 bid at 51. In other words, if the customer wants to buy, Goldman will sell him oil at 51. If the customer wants to sell, Goldman will buy it from him at 49. So what the market maker does is it will attempt to build in a spread, which is a profit margin for itself. And you know, I used to do this when I started out as a trader. My very first membership was on the New York Futures Exchange back in 1982 when they just launched stock index futures. And the New York Futures Exchange at that time was a part of the New York Stock Exchange. It was actually owned, in fact, by the New York Stock Exchange. And I went down there knowing nothing about trading. And I stood in the pit and I learned how to do this market making. So I would, the brokers would stand on the top step of that trading pit and they'd be looking to execute orders from customers outside the exchange. You know, they could be calling in from all over. And whenever a broker came in with an order, I didn't, and he didn't show initially whether he wanted to buy or sell, but the broker might look to me, and if the market was trading at 45, I'd say 44 bid at 46. We'd say 4 bid at 6, 4 bid at 6. So if the guy wanted to sell, he'd sell it to me at 44. I could immediately probably turn around and sell it out. So I'd buy it at 44. I could probably sell it out at 45. I make one tick. If he bought it from me, bought it at 46, I could probably turn around immediately and buy it, buy it back because I sold it essentially short and buy it back at 45. So I did this all day long. And on every single trade, I'd make a tick, right? One little point, one small point. And in the worst case, I'd scratch, right? Maybe I'd sell at 46 and I'd buy it back at 46. Every single day I went to work, it was like a cash machine, turning out money. Every single day, boom, 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 doing this market making. Never lost. Never, ever lost. Every single day. It was amazing because I had never done this before. And, after I learned how to do it, it was just like every day I'd go down there and I'd make money. And then what happened was that order flow to the New York Futures Exchange eventually dried up. Why? Because everybody started to trade in Chicago on the S&Ps, and I got to hand it to Chicago. And I was also a member of the Chicago Mercantile Exchange, but that was later on. That was in the early 90s, and I traded S&Ps on the floor. But Chicago was so ahead of New York when it came to derivatives and futures, and they really knew how to market the product and get the volume going. So the knife lost all its business. I remained down there for a while, but then I had to change my whole style. I had to figure out, I had to guess on the direction. Prior to that, when I was a market maker, I didn't have to guess on the direction. I was just, giving a bid and offer and making my one tick. Now with these banks, and especially with Goldman, they have very, very big customers. And they every time they make a market for their customer, they make sure that they pad into that bid and offer spread a very profitable spread for themselves, okay? So when they say trading, it's not like the trading we're trying to do here, where we're trying to figure out in a macroeconomic sense, in a fundamental sense, what's going to happen to the economy, what's going to happen to the stock market, what's going to happen to gold or oil or the dollar, right? I mean, I use, or the people who, follow me, we use the fundamental analysis, we use other things, market composition, the behavior of people, to try to, it's gamesmanship, really. It's a type of form of gamesmanship. But so that's what market making is, and that's why, really, if you ever listen to the actual directional calls, the forecasts of these supposedly great traders like Goldman and more, they're terrible. They get it all wrong. They're reading tea leaves. They're no good. But why does Goldman and these companies make a lot of money? It's from their market making activity, which they call trading. I guess you could call it trading, but it's not the same kind of trading that we do. All right, so there you go. That is market making. Bye.